Hi, this is Corey Payne, a financial advisor with Beehive Insurance Agency in Salt Lake City. In the mid-1990s, William Bengen, a noted financial advisor, was asked by a client how much money they could take out of their retirement account every month and not worry about running out of money. And with a great deal of analysis, he came up with the 4% rule. Have you heard about the 4% rule? The 4% rule says that in theory, if you have a diversified portfolio of money, of retirement assets like an IRA, a 401k, you can withdraw 4% each year and not run out of money. Financial advisors have been preaching this rule for many years. The problem with the 4% rule is that the number is not guaranteed and can change based on your retirement assets. For example, in 2008, when the stock market went down by 40 to 50%, retirees were still withdrawing at the same rate. After all, their living expenses didn't change just because the stock market took a dive. But because their portfolio was worth half of what it had been previously, they were actually pulling out 8% instead of 4%. In other words, if they pulled 4% of $100,000 in 2007, that means they pulled out $4,000. But if the worth of that portfolio dropped to $50,000 in 2008, they would have to pull out 8% in order to have that same $4,000 for expenses. And their expenses haven't changed. Can you see the problem with the 4% rule? You can very quickly erode your retirement bucket that way. Even though we are currently in the longest bull run market in history, there will be a downturn eventually. When that happens, you will either need to reduce the amount you take out of your retirement accounts and find another way to pay your bills, or face the fact that you might run out of money. Don't worry, because there's a better way for you to save for retirement. A way that won't leave you high and dry if there is another market crash. In fact, I'm going to tell you how to protect your money from market fluctuations and give yourself a raise at the same time. It's called the hybrid approach, and it involves something called annuities. Annuities have been around for 200 years and can make your portfolio more efficient by reducing risk. And even if you run out of money, an annuity continues to pay. William Sharpe, you may have heard of the Sharpe ratio, he's a Nobel Prize-winning American economist, has written extensively on how annuities reduce volatility in a portfolio. In a recent interview with Barron's magazine, Sharpe said, "I don't know how long I'm going to live. You don't know how long you're going to live." Annuities are a vehicle for pooling that risk. Annuities give you a guaranteed income stream. They never take a loss when the market crashes and guarantee around 6%. Even if for some reason you do run out of money, the annuity continues to pay. The result is that you lose less of your retirement nest egg and receive a higher income. As far as guarantees go, that sounds pretty good to most people. So if you have a hard time sleeping at night when the market goes down, I have a great, safe solution that will help you sleep like a baby. Call me at 801-554-7797 for more information about how to use annuities to create a strong, long-lasting retirement portfolio.